What are the 3 reasons that auditors use audit procedures? How did you answer this particular question? I'm curious. Auditors are going to use the procedures that we're talking about to do one of 3 things or all 3 things. They need to assess risks, so there needs to be procedures or steps they do to figure out what the risks are. They need to test the internal controls to see if they're working. That was a hint, by the way. You'll get it later on in the class. So you can use some of these procedures we're going to talk about to test controls. And then the only one that we've really defined so far is that auditors can use it to test the details, management's assertions over the financial statements, to collect evidence about management's assertions over the financial statements, or substantive procedures. Very, very good. And the way that Alex broke it down for us is he explained what each one of those are. The risk assessment procedures give you an understanding of the client's risk. The internal controls test the operating effectiveness, do the controls work, and then produce evidence about management's assertions related to the financial statements. Well, I told you, if you're talking about an assertion in a financial statement account, by definition, that's going to be a substantive procedure. Write that down somewhere. Because when we start to get it more into testing controls versus testing details or substantive procedures, you're going to be asked to differentiate between the 2. If I said that the auditor went and checked to see if all the locks were locked, and are they doing substantive procedures or are they testing controls? If I said that the auditors confirmed balances for cash with the bank, are they testing controls or are they doing substantive procedures? You'll have to be able to do that. And the only way you can do that is if you have a good understanding of what a substantive procedure is. You have to have a really good definition and then a good understanding of it. If you don't, that's what you need to say now. What are those management assertions again? What were the ones for, let's see. So when we say management assertions, right, we're referring to one of those. Existence, occurrence, accuracy, completeness. Again, one of those things we want to get in the habit of, because sometimes the more definitions we get, the more words we get, the more they start to jumble together, right? Management assertions in this class, we're going to refer back to that list, whether or not assets exist, whether or not liabilities are complete, whether or not revenue transactions or sales transactions actually occurred, that kind of thing. All right, so there are 2 primary ways to conduct substantive tests. One, they call a test of details. That's typically synonymous with substantive tests, test of details. You hear auditors say test details, they're talking about substantive testing. That means that they're collecting evidence about the details of management's assertions over a financial statement. What do I mean by that? When management presents the balance sheet and it has cash on it and the cash says $1 million next to it, management is asserting that that cash is real, that that cash actually exists. So guess what? Existence is assertion, cash is an account. Auditors are going to test the details of that assertion. They're going to test to find details if cash really exists. So they're testing the details of that assertion. The second is what's called substantive analytical procedures. Auditors rarely count that as audit evidence or actual way to collect really good audit evidence, because